Hello and good morning, everybody. How are we today? Justine, Ross, how are you both? You okay?
Good morning. Lovely to see you, Lee. Very good.
Very
Good.
good morning. Great to see you as well.
You've had a busy morning, Ross. You've driven from Manchester to Glasgow.
Indeed, yes. I wanted to get back up the road, miss the traffic, and be here in my little office at home and all set to go to support your webinar this morning. So, yeah, all in situ and good to go.
Amazing. Justin, you haven't quite left yet, but I know we're going to do our best to finish at 11 o'clock because you've got a very quick train out of Manchester. 20
I
past
went
11?
for the I went for the lie-in this morning.
Yes.
So I'm in a very stylish hotel room setup. So apologies, ladies and gentlemen, for the background. And I will be hot-footing it down south from Manchester on the 11:25 from Manchester Piccadilly. If anyone wants to see me there, I will see you there.
We'll go and flag you down. So we'll get this underway pretty quickly. As always, good morning and thank you all for joining us again on a famous Friday for a club webinar. We do intend for it to run for the full hour, and Justine's hoping it doesn't run over the hour, but Ross is going to hang around for us for as long as we need. So please do make the most of your time with us. The chat box is open. Jade, good morning. So please do feel free to ask any questions at any time throughout today's webinar in the chat function. If you'd rather be a little bit more anonymous, you can use the Q&A section as well. We've got a couple of polls scheduled throughout today's webinar, so we'll run those. So please do participate. It's good to get your insights as to the questions that we're asking. As always, I'm a huge advocate for feedback, so please do give us some feedback at the end of the session. When you exit the webinar, there'll be a feedback form that pops up. We'll ask you questions about the presenters, we'll ask you questions about the content. It will give you a chance to engage and interact with Tatton and the club as well. So it literally takes no longer than 2 minutes, and we really appreciate everybody that takes the time to complete some feedback for us. So without further ado, if my clicker works, we'll move on this morning. I just want to touch briefly on the club and the membership experience for business owners. Everything that we do at the club is really based around the structure, the guidance, clarity, and the accountability within your businesses to make everything absolutely possible and achievable. We usually start with a real in-depth 3-year business plan. We then break that down into a smaller 12-month roadmap, and then again, even smaller into 90-day sprints. If it's not written down, you don't know what direction you're going in. So it's always good to have a clear plan mapped out in front of you. You could be looking at the growth aspect of your business. You could be looking at the operations. You could be looking at tech, people, culture. Either way, the club is here to support you along your journey. Some do see us as a non-exec direct. Some do use us as an agony aunt. Either way, we're here to help you all. So that is just briefly explaining the club experience for business owners. Outside of that, everybody knows that we're building a community for every single profession, every single individual within our wonderful profession of financial planning. So our WhatsApp groups are absolutely buzzing every single day. It's just real meaningful conversations. If you've got any questions that you want answers to, it's almost immediate responses. Some of the groups absolutely love it. I think there's over 500 power planners in one of the groups that we've got. So there's always some good technical stuff going on in there, along with the advisor WhatsApp groups as well. So if you're not involved in any of our communities, it's completely free to come along and interact with us. So please do so. Our webinars are always expert-led. That's why we've got Ross and Justine here with us today, highly practical and are CPD accredited. So again, at the end of today, you'll get an email from us inviting you to fill out the form so you can get your CPD certificate for today's session. We know nothing replaces face-to-face events. Justine's experienced it firsthand, even though I do think you had to shoot off that day as well. You're too busy, Justine. We need to have a look at your diary management.
Thank you. I'd appreciate that.
We know nothing replaces real-life connections. So our in-person, and these are really strategy days. Put your teeth in today, Lee. It's about building better businesses and really good relationships with other business owners on similar journeys to yourself as well. Our podcast is on demand. You can listen to that on all of the usual platforms, your Spotify's, your Apples, and whatever else, wherever else you go to get your podcasts. You can hear from business owners, the highs, the lows, the ups, the downs, and how they got to where they are today. We also took our podcast on tour at the Verve conference, where we recorded 21 episodes. Justine, you was there. You was on it, right?
It was epic. And my highlight of the day, apart from eating my lunch on top of the giant yellow rubber duck, it was fantastic. Although very, very cringy watching it back. Nothing so painful as watching yourself back, is there? So
no, there's there's a very sad story about the rubber duck. It's still in London. We are unable to get it collected, but bear with us. We will be reunited with the big duck very, very soon.
I'll pick it up for you.
Yeah, you're there. You're going to be there in a couple of hours.
Yeah, I'll get it. It's fine.
It's deflated. We have sort of quarterly CEO roundtables as well for business owners that really want to talk about ways to move things forward in their business as well. So there's a couple of ways that you can interact with us at the club every single day. We are on tour. We are going to Birmingham Friday the 28th of November. So this event is exclusive for business owners and standalone self-employed advisors who are wearing multiple caps at one time. So if you are in the area or you can get to Birmingham, please do let us know on Friday the 28th of November. There, again, on the feedback form, there will be a question that says, do you want to come to our event? If you hit yes, we'll send you some more information. To give you a bit of an insight as to what that day looks like, we kick things off with a real engaging personal motivators session. It's really about rediscovering your why. It's really interactive. That's run by Lewis. If for those of you that have had the pleasure of meeting Lewis, you know he brings a tremendous amount of energy to anything he does. We then look at strategies to win and retain clients across multiple generations, something that me and Justine see eye to eye on. We had a presentation, we had a bit of a webinar about the different generations a couple of weeks ago, wasn't it?
Yeah, a few weeks ago now. We agreed on something. It was amazing.
We agreed. Yeah. Don't be like that. We agree on a lot of things. And then we finish the day off by building a client referral scheme that actually works. So it's a really good, fun and interactive day. Everything that we do at our event is completely collaborative and interactive. So sitting and listening is simply not possible. You get 5 hours of CPD and it is completely free to attend. So again, do let us know if you want to come along. You're nearly there from me. We've got 2 more webinars lined up for you to register to. So Friday the 14th of November, next week, we're joined by Aspen for another CPD session on goals-based investing. So it's for the next 10 years. So this one's all about helping advisors shift from really being product-led to a goal-based approach, if you like. So really aligning portfolios with real client objectives. That's going to be a really good session. Another great session from Aspen coming up. Following that, on Friday the 5th of December, we are joined by Pilot. Pilot is a back office piece of tech that is built by advisors. It's a really good piece of tech. So it's going to be a really practical session focused on where advisors are losing time and how tech can make smarter systems help you get some of that time back, really. So if you want to see a bit of Pilot's tech firsthand, please do register for that webinar as well. As always, just a quick shout out to all of our collaborators. We couldn't do what we do without the incredible support of every single one of these firms. They're all huge advocates of innovation and a genuine desire to really make a difference in today's industry. And that's what's really, really nice. So from technology to training to MPS, marketing, compliance, recruitment, everything that these guys do really do support every financial planning firm that is a member of the club and our communities as well. So just another big, huge thank you to everybody now collaborating with the club. So this leads on to today's session. Joining me is Justine again, MD of Tatton. So that's changed since our last webinar. So I had to amend that this morning. Over 25 years FS experience. You've got a passion for celebrating the work of financial planners and championing great client outcomes. Driving force behind Tatton's mission to make investing more accessible and affordable. We're joined by Ross. Ross, your bio this morning is put together by Justine. She spoke to me as if I'm the best typewriter in the world. I looked up and I'd red lines all over my screen. So if any of this doesn't make sense, do apologise. Over 30 years experience across a number of leading providers, including Schroders and more recently Tatton, championing the IFA sector through his strategic partnership directorship work. Are we about right? We're about there?
Oh, and listen, if I've written that myself, that's exactly what I'd have said. So thank you, Justine. Clearly our conversations resonate in the way that we work together.
Love that. So before we dive into your presentation, your deck, here's a quick look as to who's joining the session today. So we've got a good mix of planners, advisors, power planners, principals from both independent firms and networks. And it's quite diverse. So a lot of people are talking about their CIP, if you like, and sort of reviewing that annually, biannually. Some people are doing it every 3 to 4 years. The majority of people are already using some sort of MPS service, and others are definitely indicating that they're going to consider adopting that in the near future as well. So we've got a room full of people clearly focused on structure, consistency, and keeping portfolios balanced and effective. Guys, over to you. Thank you so much for joining me today.
Thank you very much, Lee. Ross is going to be driving on the slides today, so if my very able assistant could share the slide deck, that would be fantastic. And in the meantime, I'll just start by saying a huge thank you to everybody for joining us this morning. Number one, I appreciate it's Friday, so a double thank you for that. And number two, it's such a pleasure to be back working with our friends at the Financial Planning Club. Really refreshing to work with such an innovative business on the side of the planner, on the side of the power planner, and really driving support and independence for everyone in the financial planning world. It's so refreshing to work with a business that listens to providers and financial advisors and brings us both together. So very grateful for that.
Justine, stop it, but keep going because Ross is struggling to find the PowerPoint. Just keep giving us the thing.
I'm sorry, I've got your slide is actually in front of me at the moment, so I'm sorry.
can't take control.
Let me stop. I'll stop sharing mine.
Yeah.
I think
that might be it.
There we go. Wow, we've all gone really big now. Can you share now, Ross, or do you want me to?
I should be able to share this. I apologize. I am sharing this here, and it's just I'm scared I pressed the wrong button here. Apologies.
It's all right.
Is that it? Can you see?
Not yet.
No.
Shall I try?
Apologies. I have pressed share, and it doesn't want to.
Right, I'm going to share. And we'll go see if mine works.
There we go.
Okay,
we're in.
Perfect. I'll drive. We'll start. Okay, let's get going. We're all good. Okay, so we're going to double hat it. So you've got me for the first part. You've got Ross as the meat in the sandwich, then me for the second slice of bread, and then Ross is the garnish for the very end. So, ladies and gentlemen, let's get started. This presentation built based on advisor feedback, hopefully relevant for lots of you. It sounds like we've got a great mix of people on the call today. So whether you are an advisor looking to exit or thinking about planning your exit, whether you're a power planner in a business that could be growing or maybe going through a period of change, or whether you are an advisor looking to grow your business and bring new talent in, we really hope that this is going to be a helpful canter through the incredibly complex but equally wonderful world that exists there today. So let's start with some wonderful statistics. One of the best thing about building presentations is the great way we get to immerse ourselves in the data. And I built this presentation a couple of years ago now. And one of the things that really resonated with me is the fact that there still are not enough financial planners to go around. The number of financial advisors and advice firms remaining relatively static. So this is an incredible pool of excellence, which really, we know that less than 9% of clients access financial advice. So a genuine shortage. So a feel-good statistic to get us started with simply not enough individual clients getting supported. Now, another interesting statistic is the percentage of advisors that sit between appointed representatives and directly authorised financial advisors. This has been relatively static as well, but we are seeing a little bit of a move away from appointed reps as the number of networks are starting to shrink towards directly authorised. But of course, we know that the directly authorized space is the really path less traveled and the path that's really, really hard. So I am firstly full of admiration for anyone who is brave enough to be a financial planner. It's an incredibly challenging job, and the work you do for your clients is incredible. But for directly authorized planners, then it's wonderful to work with you and support you. But thank you for taking that step. I know the regulator doesn't always make it easy for you. So hopefully some of the content that we share can be helpful to you. So let's start by celebrating the great work you do and hopefully making you feel good. Moving on to understand what is happening in the market. So why is it that we're seeing this huge increase in value for financial advisor firms? And why are we seeing this huge interest from private equity and consolidators in your individual businesses? Well, we've got a number of factors at play. Firstly, the one I started with, that there's just not simply enough of you to go around. Your businesses are a scarce commodity and they are incredibly valuable. Why are they valuable? Well, the first of those is the fact that your revenue seems to grow year on year. The work that you do with clients, the fact that the way the assets are held on platform and the income is renewed year on year, this makes it really attractive. You are becoming more profitable, you're working harder and harder and using technology and adopting that well to scale. And this is driving up revenue and making your business look from being very attractive to being incredibly attractive to acquirers. Your pre-tax profits also continuing to grow, and the fact that we are starting to see advice firms come together to create consolidation. This in itself is really attractive to consolidators as well. Now, what do they want to do? Well, quite simply, they want to get their hands on your assets and your recurring income, because by aggregating and bringing together that scale, this gives them the opportunity to create that overall vertically integrated stack, whether that be on a restricted or an independent or a partially independent basis. And that, of course, is the shape of consolidation that we're starting to see emerge. Interestingly, this week I was on a panel debate with a couple of other industry bods, and there was a question asked: are we returning to almost a pre-RDR environment where we see a return to restricted advice with less of a drive towards polarization and independence? As consolidators start to bring together lots of the smaller independent firms, is the biggest risk of all that we lose that independence. And I think that's something that we could probably write a whole other presentation on, but we encourage you to be passionate about your independence and hold on to it as long as you possibly can. It's super important for client outcomes. Now, with all of those good news and that fantastic statistics, why is it that our research tells us that so many financial advisors are looking to sell? And why is it that so many firms are also looking to grow? Well, you're going to see a couple of quotes from the wonder that is Warren Buffett during this presentation today. And the first of them there from him saying, well, we all have to exit at some point. We are either bought out, pushed out, or wheeled out. Well, I'm nearly 9 years into my journey at Tatton. They haven't managed to wheel me out yet. So fingers crossed that will long continue. Do we have a poll there, Lee, or is it after the next question? Slide.
Are you on slide 6?
So I'll do this one. That's fine. Perfect. If we're not going to be wheeled out by Warren Buffett, why is it so many advice firms are now starting to look at selling? Well, this could be taken either way, this slide. We can think about why opportunities for firms looking to grow exist, or we can think about why so many firms are now taking a moment now to reflect as to whether this could be the right time to exit. So the first point we see there, rewinding to 5 years, it's incredible to think that it's 5 years now already since we had that COVID lockdown period. Well, that created the most exceptional time for pausing and reflecting. And our experiences at Tatton, I think, were common with a lot of our peers. We felt from our financial planner community that for the first time, they stopped to think about how they're engaging with clients, how they're working on a remote or a hybrid basis. And I think we started to realize the value of our time, and we started to value time more, or certainly time with our families. And a number of businesses at that time may have thought, well, actually, this could be a good time to take stock and to think about what it is that I want to spend my time doing. Maybe a moment of reflection on the back of loss of a family member, or just a period of reflection by the changed environment that we all found ourselves in. But we certainly have noticed a number of firms using that as a trigger to sort of have a tot up and think about how they want to spend their time, even looking to move part-time or to merge with another business to create a better work-life balance. And I think if you combine that with the higher than ever multiples for your business, we know that you're receiving calls day in and day out from consolidators and aggregators. with this private equity money coming in, and even with the rise in interest rates and the different environment we see ourselves in now, we know that those deals and those offers are still pretty prevalent. They may have settled a little bit from 3 years ago, but we still know that those valuations are pretty compelling. When you think about your life's work, it's definitely tempting to think about taking a partial payment, at least if you're going to do a phased exit over a number of years. If we then move on to the dreaded R for regulation, we touched upon this with the move from appointed reps over to DA and how hard that is. Regulation, really the gift that keeps on giving. And I've listed a couple there with consumer duty and rising PI costs, but impossible really to see how we can drive increased profitability with the higher burden that we're seeing, whether it's around transparency, treating customers fairly, the newer term consumer duty, costs of business, employee costs, PI costs, premises costs. It's really, really challenging to run a small business. And as small business owners, we know that you are under pressure. And this is also driving a few businesses either to come together to create efficiencies or to take this moment. I'm going to gloss over the aging advisors because I'm sure you're all super young and fresh-faced this Friday morning. But you can Google the average age of a planner. And as long as I've been in the industry, and that's nearly 30 years now, so I'm catching you up, Ross, average age has been 58 for every single year that I've been in this industry. So there's clearly some young people coming in, but it seems that a number of business owners are hitting that T-junction and thinking, is this the right time? So all of those factors compounded with a rising cost of capital, the temptation of taking a bit of risk off the table is definitely driving those higher multiples and getting us to think why now might be a right time to sell. Over to you, Lee, for a little poll.
There we go. And we see this a lot. So there's the first part. So we see this a lot in our other business where we support advisors with their options. But I think it's about when they want to exit the industry, and not everybody wants to exit at the same time. So when these businesses are going on a journey and they want to exit, sometimes advisors are pulled into it when they don't necessarily want to be. You know, when they started off as an IFA, for example, and then they're being almost bought out and consolidated, now moving into a restricted proposition, isn't it? You see that and hear that a lot at the moment, don't you?
We do. It's definitely a recurring theme, and one that, as an advocate of independence, we really, really try to fight very hard against, as you may have heard from my earlier narrative. And the answers to the question definitely reiterate that point, Lee. So thank you for your honesty and candid nature in answering that poll.
Yes, absolutely. So just to share the results, I think it's a landslide, right? It's 100% somewhat. There's pros and cons to consider on both sides.
Absolutely. One to definitely think about. Thank you very much. I'm going to hand over to Ross now, who is going to talk about the next part of the presentation. So we're going to think about the routes to market. So Ross, over to you.
Great. Thank you very much, Justine. Thank you very much, Lee, for that very kind and warm introduction. Let me just remove this poll if I can from there. Yes. So again, having taken all the points that Justine has just highlighted in terms of what has been happening in terms of the industry, what are the kind of routes in terms of if you are looking for exit? And again, ladies and gentlemen, we have put on this slide for you here a lot of the names that I'm sure are very familiar, that you've certainly heard a lot about over the last couple of years. So your likes of IWP, AFH, True Potential, Brewin Dolphin, Ascot Lloyd, certainly been very active in 2025, along with Forster De Novo as well. There are, though, again, with different ways that you can look at this. You can look at, what do I actually want to try and do with my business? And we believe at Tatton, in terms of how we've evolved this presentation, as Justine mentioned, that we put together in the last couple of years, really fall into the kind of grey boxes at the bottom. Number one is you can look at selling to a large-scale consolidator, as some of the names I've just highlighted there, or you can look at some of the nationals or even some of the networks. Again, we've seen this great terminology kind of coming out in the last couple of years where we see hubs being created. These hubs are in the kind of geographical areas in terms of where all of a sudden businesses then can, if you like, link into. So whether that be Manchester or Glasgow or Edinburgh for, say, a Scottish connection, or down into the likes of Bristol and into London. The other way, again, that you could look at this is you could actually sell to a local competitor or a friend that maybe you've met at various different events that you've actually just decided actually maybe a good fit for your business to kind of link into. And the third one, where we have seen quite a lot of interest, and again, is a way that actually existing advisors can retain, if you like, an ongoing interest in the business, is through what we call an employee ownership trust. And again, we're going to go into a little bit of detail of how each of these can actually play out at the same time. So getting into the finer detail, what does it look like in terms of if you are looking to sell your business? And again, from our experience and just having, again, picked up this information from talking advisors, there really is kind of three kind of variations, if you like, of this. The first one is what we would call the standard one, where you would get, after lots of due diligence, you come to agreement, you sign heads of terms, and you end up with 50%. But then you then look at a multiple of recurring 2 to 4 times of recurring income, and those installments are then paid to you over a 2 to 3 years with targets to be hit. Now, that's quite interesting terminology when, again, from our experience, talking to a lot of advisors, they have built businesses up by looking after clients through the accumulation journey, going into the decumulation journey, and then all of a sudden, somebody where you all of a sudden become from landlord to becoming tenant is then saying to you, just to make sure that actually we can, if you like, roll your business into the business that I am running, I just want to make sure that we hit some of these targets on track. And again, hitting those targets, there will be installments. And all of a sudden, the words, key performance indicators come in, which could be new language, again, for somebody who is maybe thinking, oh, I thought this would actually be a lot easier than this journey. There are other variations in that. You can look at things like, cash plus shares. Again, that can actually then mean that you still have skin in the game, if you like, in terms of how the business would look to try and evolve. And then the other one, obviously, is salary consultative, maybe for a longer duration as well. The earn-out period, again, in our experience, and again, just talking to advisors, seems to be around about that kind of 2 years. And the reason for that is somebody buying your business wants to have a good period of time through, if you like, regular updates, client, if you like, ongoing kind of engagement, making sure that the client is on that journey and just slowly being introduced, and hence why we are looking around about a 2 year period. So again, it's something that you really do need to take into consideration going down this route. So again, looking at this and trying to just pull us all together, the kind of three routes that I mentioned, that was really the first route as well in terms of what that looks like. And we're now going to go in and just share what the other two potentials will look like at the very same time. So the other side is share purchase. Again, just highlighting a little bit of that for you. And again, it also could be seen as the belt and braces approach. This is where actually individual acquires the whole business. And interesting here is the second point, again, where the advice liability transfers with the sale. Again, ladies and gentlemen, you might have been involved in the DB market. Again, and as you know, these liabilities need to be transferred across. And again, anybody looking to acquire a business, or if you're even thinking of an acquiring business, you want to fully understand what's underneath the bonnet. What sort of liabilities could you be taking on board within your business? And again, the more of those possible liabilities there could be in terms of the multiples that could be passed across as well. Again, a lot of people, and again, from my experience, even the smaller advisory business out there are several person organizations. And again, those employers, again, want to make sure that they can look after, if you like, their fellow staff in terms of how they are, if you like, traded across. So again, out of interest, whilst they are looking at their potential earnout, etc., they'll also be thinking about how their staff can be, if you like, two-peat across in a suitable way. And again, that all links into that 2 to 3 year earnout period with future payments, and then the final payment made on the performance during that period of time. That's really how we would see the share purchase play out. The other side, though, again, is this trade and asset sale. So this is, again, just looking at the kind of overall goodwill in terms of actually ultimately buying off or buying the company. Again, from our experience, we've talked to a number of advisors, and again, we see that this here, you would need to have some form of runoff cover needed for any liabilities retained. Again, potentially there could be higher earn multiples, and again, because there is no liability. So again, you might be selling off a vast majority, but retaining part of that business where the liability, and again, the individual keeping that would, of course, then need that liability cover in there. And then we're down into the kind of 2P stuff. So again, making sure that actually all the kind of benefits, etc., that your existing employees have can be matched across and there. And then ultimately going down this particular route, you are just left with the shell of the business with no clients or assets. And a good opportunity where actually, when maybe being a jack of all trades, that actually you maybe want to just end up in maybe one or two areas of the kind of financial services going forward. And again, typically you could sell off part of your book. Again, ladies and gentlemen, we have met a huge amount of advisors. And one of the things where I have found in conversations become very interesting is with the older advisor. And I've asked them questions to say, what keeps you going? Why are you still doing what you're doing? And I kind of chuckled a few times when some of them have said, my clients have said to me, whatever you do, don't you retire. So the clients are able to go off and enjoy their retirement. They're able to go off and have a wonderful time. And when they need that either 6-month or yearly check-in, they know that Mrs. or Mr. Constant will be there to try and help them. And I've kind of often wondered, thinking, what really is the winner in that situation? Is it the client, or is it the individual that tried to help them through that accumulation and into the decumulation journey? The final one that, again, I highlighted back in the earlier slide was all about the employee ownership trust. And again, we've seen a number of these situations in our industry. Chris Budd, an IFA down in the Bristol area, he was one of the first in this particular area to kind of highlight this and promote this, and even wrote a book all about employee ownership trust. And just very quickly, just to give you a kind of quick run through as to why this can be very appealing for certainly individuals who have maybe built a business. They maybe have a number of very long-standing fellow employees. They still want to retain an interest, etc. And maybe the employees are looking for that consistency and continuity taking over the business so the clients aren't displaced in any way. You can actually end a situation where you end up giving away your controlling stake. Again, you're maybe passing that across to your employees who you know have been adopting all the way that you've been using your various different methods in terms of your centralized investment proposition, and even into a centralized retirement proposition. So that consistency and continuity, it gives a flexibility overall for the business. There's that consistency where actually the clients will always be able to recognize the name of the firm and certainly the name of the individuals, even the paraplanners, even the admin, etc., that make the whole business run. The client probably might not even notice a big change. Maybe even all they would see is maybe a change in their advisor. But the fact is, there's been that kind of gradual handover. Again, for the individual that looks at passing this across, future payouts are based on actually what the employees do in terms of running the business. And again, if you really trust your fellow colleagues, etc., you will have every faith in them that they will consider, or sorry, can keep that consistency and continuity going, and financially it can help as that one. It's a nice one as well. It helps with cash flow. And again, there has been some discussions around kind of the CGT piece on that one as well. And again, it's one I'm sure that there could be still some benefits for you at the same time. So look, sorry,
Ross, there was a little poll that we're going to just slip in there as well.
There you go, sorry.
When it talks about the EOT and everything, it's more about a cultural change for employees as well. So if there's a concern. So whilst that poll's running, I just want to talk to you as well, because I know you mentioned about advisors retiring and not letting go and hanging on forever and a day. So a firm that we support, who support advisors retire, if you like. So they could be working under a firm that doesn't have any succession planning in place. So it's of their interest to move to a firm that can acquire their client bank. They outright say that the hardest part of getting an advisor, or why an advisor never retires, is because they don't have a plan in retirement themselves. So that's where they say they find it the very hardest for them to let go of their client banks, because they don't have any plans in retirement. What are your retirement plans? If they say, well, no, nothing really, I'm just planning on retiring, then they know full well that it's just going to hang on and hang on and hang on and hang on.
Yeah, no, it's a great point, and actually, we're going to touch on that in a bit more detail later on in the presentation, because I think it's really, really important that you have a plan in place, and it's
100%.
no different because when an advisor sits down with a client, as part of the fact find is all about is what is the client's plan, and the advisor, he or she, is trying to help navigate that journey for the client. So the advisor must have a plan, but we do touch on that in a bit more detail, Lee, in the presentation.
It's interesting because you speak to a client, you would say, what, you know, if one of their clients was planning on retiring in the next 10 years, you'd be putting a really firm plan in place for that client to retire in 10 years. But if you're an advisor and you're thinking about retiring in 10 years, what's your plan on the sale of your business? Because you need to start thinking about that way in advance, because the more of a run up you take at this, the smoother that transition is going to be. We've had it in a couple of situations where, due to poor health, somebody might need to exit the industry a lot quicker. Yes, circumstances might change. They might need to just sell their client back. And you do get a lower multiple on the value of your business if you are looking for a quicker sell. The longer you're with that firm that you are going to be selling to, the more they can see your business, your clients, your annual reviews, absolutely everything. That's where you're going to be getting your better multiples.
Absolutely. Lee, it's a wee bit like we buy any car.
Yeah.
If you need to sell your car quickly, we buy any car. We'll buy your car really quickly for you, but it'll give you the price that maybe you believe your car is worth.
Yeah. Yeah, absolutely.
You might not get quite the best value. We've definitely had similar experience at Tatton in working with lots of wonderful firms and hearing their journeys, and understanding the importance of signposting early with clients that they're going to exit, and really starting to lay the foundations for what the future might look like. And that leads us really nicely into the next part of the presentation, which talks about that very pointly. So how long does it take and when do you need to start planning? We get asked this so often by our firms. A long time, and probably longer than you think, is probably the answer. And that's if you get the very, very right partner from the off. So think of it a little bit like dating. You're going to have to kiss a few frogs before you find
100%.
your friend. Ladies and gentlemen, and this is definitely no different. So if you get the right one from the off, it's still going to be 6 to 12 months to get that deal over the line once you agree the very shape of it. And there's an awful lot involved in finding that shape. And as we've already heard from Ross in terms of what the earnout might look like, unless we are going to take the money and run, which is a really difficult thing for most advisors to do, because we built such long-standing relationships with our clients over many, many years, that when we come to that earnout, it's actually easier emotionally to transition out over a number of years, and also better for the ongoing income of the business. You're going to get a better return there, because that smooth handover and introduction of the new firm. There is a balancing line between the right amount of time and too long, though, because as I've worked with firms for longer after sale, there gets a point where everyone's been handed over and you think, well, what am I adding here now? So, but you need to do it long enough that that new business is entrenched and those relationships are working. You've introduced the new planner or planners, and the brand and the consistency has moved across. So if you're trying to get out in 3 years, you probably need to start now. We need to start looking at the market, speaking to the experts, whether it's the Financial Planning Club to be your business consultant, or you work with one of the independent consolidators or brokers out there. But get that date in mind, whether it's a target AUM, a target income, or even a target number of years in your life. If you're thinking, right, 60 is my number, 50 plus that, as Ross refers to it. But when you get to that number, that might be the point when you say, right, I'm going to start now. I'm 57 now. I'm going to start planning. And if you're growing, so if you're looking to bring firms in, then this is the time to start networking, talk to the people in your area, talk to the people you meet at events, and start thinking what their plans are and whether they could be a really, really good fit for your business. And there's work that you can do to start planning in terms of your investment proposition, your platform, and reducing risk within your book as well. And we'll come to finish the very end of the presentation looks in a little bit more detail.
Yeah, I just like to add to that as well. I mean, when we look back at your stats at the beginning, Justine, we spoke about 33,000 advisors, 14,000 firms. So a lot of the industry are self-employed advisors working under an RI model of a DA firm, if you like, or as an AR. It's important for these guys and girls and people that are building these businesses that they've got a home where they can sell their client bank as well and retire at a time that they want to retire. And I always say to people, think about it, if you're not retiring now, just where do you plan your business to be in the next 5 to 10 years? Because if you can't sell where you are, then it'll be harder for you to sell further down the line. A lot of people say, I'm going to build a business over the next 10 years. I'm going to build up as much AUM as I can, and I'm going to look at retiring. Now, if you're going to do that under your current firm that can't facilitate that purchase, then what happens is further down the line, you've got more clients to move anyway. So it's a little bit harder for you to move. And also there's a lot of change for a client. You know, you've been at one firm for 7 years, you've moved to another firm, and in 3 years you're gone. So if you do that much earlier on and you spend the last 5 years or the last 10 years with the firm, it's less change for the clients as well.
It is. It's about thinking about where you're going and starting to prepare and think really, really early. And businesses that are easy to value are always going to be able to be bought for more money. And it's about thinking early about, if I was a buyer, what would I be looking for? 100%. So for this slide, we need to put our hat on and imagine we are a buyer. We need to not take this personally, and we need to think about what are the questions we're going to be asked by anyone, whether it's a broker that we're engaging with to sell our business, or whether it's a buyer that's approaching us, those emails and calls that we get saying, would you like to talk to us? We'd like to know more about your business. Remember, your data as a financial planner is available on the FCA register. It is accessible to everyone. They can tell how many people you've got, what permissions you hold, and what role you hold. So who is in your business as the approved directors. So this data is what is used, and this is why you're getting the calls that you are. So when those calls come, we want you to be ready. We want you to have all of that information to hand. And as Lee says, we want you to have time to prep for that. So really, we can split the due diligence, horrible word that it is, into 3 key sections. We can think about this as financial, regulatory, and legal due diligence. So starting with the financial, probably pretty obvious stuff. This is the time to get down and dirty with your P&L. So whether you are a numbers person or not, we need to understand our profit and loss. We need to know what's happening in our balance sheet, where is our recurring revenue, what type of clients are profitable for us, where are our assets sitting? So where are they spread across investment propositions? Which platforms are they on? How can we demonstrate our influence over those assets and the opportunity that exists within that client bank? Are they in 1 investment proposition, 2 investment propositions? Are they across 10 platforms, or are they neat and tidy across 1, 2, or 3? And then finally, what is the age and location of those clients? Are those clients having a good longevity ahead of them, or are they entering decumulation and starting to eat through their books, and therefore their ongoing income looking a little bit more challenging? And geographically, are they disparate, spread all over the UK, and perhaps more challenging to service for the person who may be wanting to buy them, especially if they're hooked on face-to-face advice? Or if we've made the transition to hybrid, are we able to evidence that that book can be lifted wholesale into a new operating model? So this is your bread and butter, really going to drive how easy your business is to value and how attractive it is. So be ready for those questions. Then moving on to the regulatory side, this is the fairly standard stuff around your housekeeping here in terms of claims and risk. Is there anything nasty in your back book that you've got ongoing, whether it's a piece of regulatory action or enforcement action? Ross touched upon DB transfers. If you've got them, no problem. They're part of your business and you have the qualifications and the expertise to do them. But can you evidence the ongoing suitability of those? Has the regulator been and had a look? Is everything neat and tidy with them? If you're a multiple advisor firm, a buyer is going to want to understand what the model is for the other advisors within your business. If you are the exiting principal, what stats and how are your RIs working? So are they all working in the same way? How are they charging? What is their income? And what is their model? Can you get everyone doing the same before you come to sell. That's going to really help grow the value of your business and evidence your control and sort of control and command over the other advisors in your business. And then finally, moving on to the legal due diligence, this is really where the cost and the hidden nasties can be. So is there anything in your business that would be transferring over, especially if you're selling it wholesale, in terms of ongoing commitments to staff, maybe leasing of cars, property costs, and maybe any ongoing litigation or complaints that could come back and bite you in the future as well. So it really is a time to be honest. I would liken this to filling out a medical questionnaire if you're applying for an impaired life annuity. Be honest, tell the truth, because it's going to come out. This acquirer is going to ask, they're going to ask these questions. So getting it out early, telling the truth, and tackling any difficult points, you can be sucked into a black hole of time going through regulatory due diligence. And you don't want to waste 6 months of conversation, of legal fees, of lawyers' costs, and your times from your staff and your own emotional energy to get to the end and them say, well, you've got 82 DBs, I can't take you. And that means half your book is off limits. Just be honest and get it up front. This is your lifeblood. You've done a fantastic job. Be proud of it and really tackle those difficult questions up front and early. And then moving on to talk about what integration looks like. This is the most emotional slide in the whole presentation, because here we talk about what life looks like after the deal completes. And this is where we talk about the living will, the sale and purchase agreement, the SPA. You hear it termed as an SPA. The sale and purchase agreement is where we put all the detail about the future. This is where you and your buyer, or if you're a buyer, you and your seller are going to agree what the future looks like. So we're going to be putting detail in here about investment proposition, about how your clients are going to be serviced. What will they be charged? What will the brand be? Who in your team is going to stay? Where are they going to work? What will the name of the company be? Who will you buy your compliance services from? Which staff will stay? Which staff will not be staying? And how will that relationship between the buyer and the staff that are left behind work? What does the journey look like for your clients? Because when it all boils down to it, the numbers are going to be roughly the same regardless of who you're talking to, but the journey and the outcome for your clients could be really, really different depending on the path when we look at those 3 options that you choose to follow. So asking these questions really early so that you can still go to the same Sainsbury's and see your clients 3 years, 5 years, and 10 years after the deal completes. This is what we hear from the wonderful firms that we're working with. We don't want you to have to change your supermarket. Let's get it right and let's get the right deal done up front. Perfect. So this is where we come to housekeeping and doing our planning and thinking about taking our second quote from Warren Buffett. So Warren says that price is what you pay and value is what you get. Whether we're talking about socks or stocks, he likes to buy quality merchandise when it's marked down. So put the time in, do the investment and get yourself ready. Get everything neat and tidy by doing your preparation in the key areas. So we've touched really, really briefly upon these areas of risk profiling, centralized investment proposition, and platform. The key thing to integrating a business is simplification and making it easy to value and easy to integrate. So if you are a buyer, you're going to be thinking, right, I'm using this risk profiler, whether it's 1 to 8, 1 to 10, 3 to 8, there are so many different approaches out there. This is my core CIP, so I'm using this or these providers, and I want the assets to be on this or these platforms. If you can find businesses that are going to largely match up, they're going to be very easy to lift and shift and hopefully still deliver great outcomes to clients. And we spend a lot of time bringing together businesses that are like-minded and share not only culture, but these 3 key factors in common as well. I think we've got another poll, Lee. Over to you.
We do indeed. We do indeed. So this is long-term business planning. So do clients ever ask about your longer-term business plan at any stage? So that's interesting. So are you relating to the clients asking the advisors what their long-term business plans are? Interesting. I would say probably rarely, right?
Yeah.
Correct. It comes back to what you were saying earlier on, Lee, about the advisors not really planning. And again, when I highlighted 2 examples of where we've come across advisors where are still working because their clients have said, I'm retiring, but whatever you do, don't you retire because you're my constant.
Yeah.
Absolutely.
I mean, fancy spending your career planning everybody else's retirement and just leaving your own until the last minute.
Yeah.
So
Yeah.
true. Such a good point. Such a very, very good point.
Yeah,
Wow.
it's like any typical trade, isn't it? It's like a landscaper never finishes their own garden because they're too busy doing everybody else's garden.
Spot on.
Not fair though, is it? If you spend your life helping others and then nobody comes to help you.
Yeah.
Well, there seems to be a fairly healthy cottage industry of brokers that have sprung up to help advisors make sure they navigate this market, Lee. So
Absolutely. Absolutely. So, yeah, I don't think the poll results are too surprising on that front. Majority saying rarely or never, which is,
definitely not.
yeah.
Exactly. Perfect. I am going to hand back over to Ross for the final part of the presentation, and then we will take any questions at the end.
Thank you, Justine. Yes, just kind of building on everything out there. And again, just looking at advisors' businesses. Again, our research has highlighted that there are over 100 different forms of tech advisors can use to help run their business. And again, just at the point Justine was highlighting in the previous slide, if you are using some of this tech, and then also you're looking at acquiring a business or someone's looking to acquire your business and they're using different other types of tech, then it's very difficult to kind of bring that in and kind of make it a nice, smooth kind of journey. What do I mean by some of this tech? Well, there are 29 platforms in some shape or form out there. And again, platforms really are now the aggregators, the custodians, if you like, in terms of where clients' assets are. And again, there's so much choice. And again, from our experience, when we talk to advisors, they say, well, I like this particular platform because I've used this for a long time. I know how it works. I know the kind of nooks and crannies, the good bits, the bad bits, etc., but it kind of works. There's 21 different back office systems in terms of CRM. And again, in terms of making sure that you keep really good client data. And again, just looking at our friends from the FCA, they are all about if it's not recorded, then it's not happened. And again, just look at about the latest peeps in terms of where they're looking at vulnerable clients. Again, we're waiting for the outcome of that particular piece where all IFAs were asked through a section 165 to kind of fill in some details round about their clients in terms of did they deem them to be vulnerable, which was, in my opinion, leading the witness, because the second question is, so what systems and what have you put in place to look after these clients? So question two means there must be answers to question one. And again, you then go into things like cash flow. So again, there's loads of options you've got there in terms of cash flow, in terms of, putting the information in, whether that be cash calc, etc. And again, IFAs use different ones, and then into different research tools, and then into client portals. There are lots and lots and lots available out there in terms of supporting your business. In terms of when it actually comes to actually having a consistent approach, well, outsourcing has certainly grown and grown in the last couple of years. Why is that? Well, things like MiFID, PROD, consumer duty, it just makes it so difficult for advisors to be able to go and pick, if they like, in terms of putting together portfolios for clients and then going back and checking those portfolios are still absolutely relevant at the same time. Again, there's opportunities there for using a firm like Tatton in terms of what we can do, in terms of we get access to some of the best share classes that again are not necessarily available to advisors. So again, trying to support being that silent partner in the background. And again, we are seeing that outsourcing just growing and growing and growing. There's also, as well as being able to reduce the costs. Again, sorry, Justine, just a couple more points. Just reducing the costs. Again, just highlighting the kind of simplification. When you actually look at your book, you can see a consistency and continuity across the piece. Next slide, please. Again, I mentioned the 29 platforms out there. Again, our experience would tell us when we talk to advisors, advisors will say, in the ideal world, I use one platform, but in reality, I use six. And you kind of go, six. Yeah, well, let me explain that to you. I start off with one, and it's one I use as my main one, but I have a couple in the background just in case, a situation goes wrong and I want to be able to use another platform. However, I've inherited a client or I've inherited a group of clients and they're not on those particular platforms I'm using. And again, lots of the platforms are talking about their transition program, etc. But again, from our experience, a lot of advisors are saying that is a really difficult and complicated piece to do because it's not always necessarily like it becomes an in-specie transfer. It becomes a situation of a buy, it becomes a sell, it becomes a wind down period. An awful lot of the time, the advisors go, do you know, that's really something I'll just leave in the pile and one day I might look at that. But in the meantime, business gets in the way. Advisors need to look at their business, they need to run their business, and they need to continue, and hence why they end up using a number of platforms. So you can tidy up that piece, then it looks again a lot easier in terms of business. There's an awful lot to think about in terms for buyers and sellers. You know, there really is the key bit, and I think both Lee and Justine have highlighted in the presentation so far. Preparation is absolutely key, and preparation takes time, and you need to have that time to actually go through the journey to ultimately end up making sure that your, you know, all your financial sides are in good shape, your kind of regulations all inside, and your legal pieces are there as well, making sure that your housekeeping and tidying everything up really makes it very easy for a potential buyer to look at your business and think, do you know what? I can slot that in, and making that easy, I'll actually pay a premium for that. So again, it's just keeping your eyes on the prize in this journey.
You
Very
want me
quick
to do the
reminder.
end, Ross? Shall I do the last bit?
I'll do the first one, you do the second one. How about
Okay,
that,
go on
Justine?
then.
So let me go.
There you
So
go.
again, Tatton, what are we about? We are a very simple proposition, the way that we come to market. Again, you can see here, ladies and gentlemen, the stats at the top. We are now up to very close to 25 billion in assets in terms of we look after individual clients' money. Again, thankfully to the advisors that we work with, as you can see, are over 1,200 firms. We are known for our managed portfolio services. We broke the mold by actually challenging that discretionary space by offering an advisory proposition on just 15 basis points with the OCF on top. However, I am very mindful, though, ladies and gentlemen, there are a lot of advisors out there that like to use multi-asset. And again, in Tatton, we offer that. We offer our active, known as blended, and we also got our passive range as well. The blended range, again, ladies and gentlemen, I've got over 1 billion of assets. So if you are looking for a partner in terms of, you know, the route you might want to be looking at, whether it be MPS or whether it be down the route of multi-asset, we offer that as well. But at the same time, on the right-hand side, the final pillar, ladies and gentlemen, is we are very aware there are individual clients out there that want something, shall I say, a bit bespokey. And again, we can do that for you in terms of what we are able to pull together. We can use the same skill set and the same propositions, but we can also go off piste and actually put something together for that individual client at the same time. Justine, over to you.
Thank you, Ross. Ladies and gentlemen, choice. This is like the sweet shop. Think of this as the ice cream cart of Tatton. So it's not our job to tell you which is the right solution for your client. We very much see our responsibility as offering choice. So the first choice, as you've seen from Ross, is whether it's MPS, multi-asset, or bespoke. The second choice is a really important one that we know you will make. It's which style of investing. So whether you want active, passive, hybrid, income, or ethical, we have something for everybody. We have 2 strategic asset allocations, a classic and a global, and we offer a full range of risk profiles. The other thing to mention is that we launched around 2 years ago now, the Tatton Money Market Portfolio. This is a really important addition to our stable. We had a really interesting set of market conditions. We had high cash rates and volatile markets, very difficult markets. And it was very difficult for a lot of advisors to keep hold of those assets on platform. And clients were looking to de-risk and take assets off platform into cash. The money market portfolio is available across all 19 platform partners, and it enables you to track Bank of England base rate in great liquidity so that you can move money in and out on a daily basis. So a lovely holding pattern for drawdown monies or just to take a bit of risk off the table. So we have something for everyone, and we really, really are grateful for your feedback in helping us to continue to grow the Tatton stable. So on every single platform, mapped to all of the key risk profilers, making it as easy as possible for you to do business with us. And that has been really important on our journey, really challenging the market, having a simple business model and being dedicated to advisors. We can't work with your clients without you, and we wouldn't want to. We see you as absolutely critical, and having a market and a really simple business model that's so committed to IFAs it's been an absolute pleasure to work within that business and see its success over the years. Now, I'm a massive champion for IFAs. I hate putting this slide up because it embarrasses me. I normally make Ross do it, but genuinely, thank you for the work that you do. There has never been a better time to be a financial advisor, and there are not enough of you to go around. So I am your biggest fan. Tatton are huge supporters of yours, and we are hugely, hugely grateful for your support. So I will stop sharing at that point and hand back to Lee and Ross for any questions.
Amazing. Justine, I know you've got a couple of minutes before you've got to get out of here, but thank you very much for taking the time to share that presentation with us, both of you. It was a really good, insightful presentation. I liked it. And we did not know until the very end that you was running the slides and Ross was talking. We didn't hear once, next slide, please, until the very end. So you was on the ball. You was very sharp with it. So thank you very much.
That's a pleasure. I'm going to leave you guys to take questions.
Absolutely.
But huge thank you to your audience. And as always, look forward to seeing as many of you at the next event, either in person or on the screen. Thanks, Jen. See you later. Take care.
Justine, thank you.
Bye.
Bye.
So for those that are still with us, if you do have any questions at all about the presentation today, you'd like to know a little bit more information, please feel free to ask us any questions, whether you use the chat function or the Q&A section as well. Please do fire away. If not, thank you all so much for joining us today. As you exit, please do complete the feedback form so we can hear your views and your thoughts on the session today. You can also reach out to Tatton and us as well at the club. So if you've got no further questions, thank you very much for joining us and have a wonderful weekend. Ross, are you traveling anywhere today?
I'm heading into Glasgow for a meeting just after lunchtime. So yeah, it's been a full-on week, but it's you wake up on a Monday and I find it's a Friday. It's just at the moment. We've got this period now over the next all the way up until December the 18th with lots and lots of events on. Final kind of big push of the year with obviously one eye all watching to see what our friend Rachel from Accounts delivers on the 26th of November at the same time, which again is causing people to have some thoughts, some issues, etc.
Yeah, absolutely. Just for the